Some of the nation's biggest banks, I know you've all been waiting, reporting earnings this week. JP Morgan, Wells Fargo, Citi are out tomorrow, Citigroup, Goldman Sachs, Bank of America on Wednesday, Morgan Stanley on Thursday. The question is whether the benefits of the rising stock market will offset the impact of the interest rate reductions. First of all, you just got to calm down. Wilfred Frost came bouncing in here like, God, is it that exciting for you? Is it that exciting?
You didn't even mention them all. You forgot to mention Citizens and a bunch of the other banks.
It is tremendous.
Just calm it down. I mean, he was breathless talking to us on break.
It genuinely is one of the most exciting banks
I know it is for you. I know it is for you.
For a while.
Okay.
Let's get into it. So the main challenge, as Joe just alluded to a little bit there, for the banks compared to a year ago, significantly lower rates. Guidance on expectations for net interest income for the year ahead is perhaps, therefore, the most important part of reporting this week. The extent to which strong loan growth can continue to offset lower rates will be watched closely. Trading revenues are likely to be under pressure given low volatility, offset by decent fee income for those with high exposure to asset management, given strong equity markets, though wealth management margins will be pressured given the recent broker price wars. Advisory revenue and investment banking revenue should be strong, offset, though, by softer equity capital markets as IPOs dropped off. 2020 is shaping up to be a year where revenues may well be flat year over year, so there'll be plenty of focus on cost control, especially branch rationalization and shift to digital distribution. Bottom line, the setup is hard. Banks rallied last year, especially in the last 4 months. Over all of 2019, bank stocks rose 38%, all of which, and more, 47%, was multiple expansion, as earnings expectations actually declined 6%. Of all the banks reporting this week, probably the most interesting individual stories are Charlie Scharf's first earnings call at Wells Fargo. He's the new CEO, of course, and Goldman Sachs' first earnings report in their new earnings structure, the announcement of which last week gave them 5% outperformance compared to the KBW Banks Index in 4 days. Again, playing into that tough setup rhetoric for the banks.
Well, who was the best performer last year? Was it Bank of America? Was it Citi? Yeah, Citi.
Citi outperformed. It came in with the lowest price to book multiple. It still is towards the lower end of the expectation. So the price to book multiples across the big six have narrowed, but you still have the same kind of theme, which is the pure investment banks, Morgan Stanley, Goldman, and Citi at the bottom. You've got JP Morgan at the top. Bank of America has started to catch that up a bit. I mean, I think the point on multiple expansion is that the 10-year average of banks is always a little bit less than the S&P 500 average. The 10-year average is 68% of whatever the average P multiple of the whole market is. For much of the first half of last year, we were below 60%. So as a sector, they were incredibly cheap relative to the rest of the market. They've closed that gap. All of the market has seen multiple expansion last year, but banks in particular, and it's now about 64, 65%. So again, whichever way you look at it, you say the easy work for this sector has been done. Right. You now need to see earnings deliver, and it's quite a hard environment for them to deliver serious earnings growth.